Hey everyone, interest rates jumped in the last couple weeks. In this video, I'll highlight what's driving that trend and what it means for investors. Last August, the 10-year Treasury was just above the 50 basis point mark, and now it's back up to about 1.1%. From November through the beginning of January, the 10-year was trading in the 90 to 95 basis point range. Then on January 5th, it started to climb, rising about 20 basis points in the last 2 weeks. And while that seems like a pretty big jump, I have to remind everyone that a year ago, before the onset of COVID, the 10-year Treasury was in the 1.8% range. So rates are still quite low by comparison. But what's changed? A couple of important triggers have caused financial markets to strengthen their economic outlook for the year. Both of the Georgia senatorial runoff seats were won by Democrats, creating a 50-50 split in the Senate. And President-elect Biden's electoral college votes were validated by Congress, putting to rest any remaining questions on the legitimacy of the election results. Together, these events reduce political uncertainty and increase the probability of additional economic stimulus. Economists are now forecasting 2021 GDP growth in the low 4% range to as high as 5% for the year. That compares with last year's estimated economic decline of negative 3.5%. And those upgraded forecasts are putting upward pressure on interest rates. If the underlying dynamics hold, if job creation moves back into positive territory, if retail sales get a bounce, if the rollout of the vaccines gain momentum, we should expect rates to continue to rise. Not particularly fast, but the factors that had pushed the rates down are pretty much behind us now, and there will be upward pressure on interest rates going forward. We're already seeing this manifest in the pricing of commercial real estate debt. 10-year fixed financing for an 80% loan-to-value apartment property is now in the low to mid 3% range, up about 30 or 40 basis points from a couple weeks ago. Of course, rates on lower leveraged loans generally have lower rates, so apartment loans with 60% loan to value may still get financing around 2.7% or so. Other property types generally can't get 80% loan to value financing. Most of the loans for other properties come in at around 60% loan to value. And so for industrial assets with credit tenants, rates are running in the upper 2% to mid 3% range. High quality office deals should be able to get rates in the 3.25% to 3.5% range. And a well-performing neighborhood retail center with a good necessity-based anchor like a grocery store may be able to get financing in the mid to upper 3% range. Self-storage financing is also running in the mid 3% band, and hotels have an uphill battle to get financing at all. Borrowers may be able to finance through the SBA or through a local bank if the borrower has a strong relationship. But rates are on the move. That means investors who plan to buy properties this year may be best served to get the wheels in motion. Yes, it's possible rates could go down again, but that would likely only happen if there is a major setback on the economy, stimulus, or the vaccines, or some other significant turmoil erupts. But the investment climate will become increasingly competitive. More investors are coming off the sidelines because investors are looking forward to the second half of 21, into 22, and beyond. Investors are focusing their eyes on the horizon.